Hello and welcome to this week's BizSmart Lunch and Learn webinar. Our webinars are aimed to provide advice and share knowledge amongst business owners on key business topics and specialist areas. This is part of our service to our Smart Room members. If you're not already a member or a BizSmart client and would like to access our archive of webinars, then please visit our website biz-smart.co.uk and go to the Smart Room page. Our host joining me today is Kevin Brent, BizSmart's founder. And before we start our webinar, can I ask you all to use the question mark function on your screen to post any questions that you may have for Kevin, and he will answer them all at the end of the session. Thank you, Kevin. Over to you.
Thanks so much, Caroline. Right, so the topic of today's webinar, and thank you everyone for joining, is how to plan the exit strategy. Caroline, this isn't moving forwards. There we go. Thank you. Which button was that? Okay, lovely. Sorry about that. So, all about exit planning strategy. So I've taken reference from 3 books which you might like to have a look at some point. One's How to Value and Sell Your Business from Andrew Heslop. Another is The Exit Strategy, a Practical Guide to Selling Your Business from Graham Watkins. And the last, but by no means least, is Built to Sell by John Borrello. And some of you will have heard me talk about his books before. So the aim of this webinar is to provide a framework to help us as business owners to develop a suitable exit strategy. So by the end of this webinar, I'm hoping that we're going to be able to understand the reasons why we need an exit plan, why and when we should make one, explore ideas to help identify potential purchasers, look at alternative ways of exiting, look at some ways to assess value, but also ways to build on that value and achieve the maximum sale price that you might want at exit, and also to outline the planning and the management of that sale process. So this webinar will give you a framework and some activities that I'll propose as we go through that will help you to actually develop your own exit plan. So the first question of those is, why have an exit plan at all? And not many of us, when we start up our businesses, actually think straight away about when we're going to finish or when we're going to exit, but perhaps we should. And there are various reasons why we should have an exit plan. One is protection, just simply protect the value that you've built up against unforeseen circumstances primarily. It does, funnily enough, actually tend to help drive greater success in your businesses as well, because you've really planned where you're trying to get to, giving that focus. You know who you're looking potentially as potential purchasers or whatever, and the likelihood is that will drive you on to greater success. It may even help you to stay on longer in your business, because building a business for sale or for value, and as you'll have heard me talk about before, means that you're likely along the way to have taken a little bit of a step back from the day-to-day grind of the business, and it might actually mean that you start having fun in your business perhaps a bit more than maybe you are at the minute. And also, of course, the aim at the end of the day is to help you to release the maximum value from your business, so that if you do want to come out, that you don't just have to walk away, or you end up accepting a price that you weren't very happy with. Why might we leave? Well, I can guarantee that we will all leave our businesses at some point, willingly or not. So to use John Keene's quote there, we're certainly going to finish our business at some point. So having an exit strategy is going to help you get some control back over that. But the other reasons you might leave, you might simply want to retire. You might want to look at handing over control of all or part of the business to other people, whether it be family. You might want to cash in, take out the money that you can. You might want to simply try something different, whether you actually leave the business entirely or you keep a toe in the water and try something different. Maybe, but quite often, one of the key reasons why people get caught out is a change in personal circumstances. So it might be ill health, it might be something like divorce, but something out of our control that means that actually we can no longer continue to run our business. But equally, there may be outside opportunities that you want to explore. There may even be outside threats that come in and mean that you want to exit your business. So they're all reasons why we might end up leaving. So when should we start planning? Well, this is a photograph of me. Those of you know my race. This is Brent in May of 2014 in my nice shiny little MX-5 Mark 1 race car. This is me 1 month later, June 2014 at Cadwell Park. So if I was going to sell my nice little Mazda here, I think I'd get a little bit more than I would have done here. And in fact, I can tell you I got £68 at the scrapyard for that. So timing is pretty important when it comes down to it. And it should be pretty clear from that it's never too soon to start planning. And ideally, when you start your business, really, you should be thinking about the exit. May seem a bit far out, but that is really what you should be doing, is if you're trying to build a business value and really want to exit. So if we want to exit, what kind of exit are there? Well, there's some four basic ones here. The first one, flotation, for most of us is not going to be relevant. This is typically suitable for a tiny percentage of businesses, and the significant costs involved with that as well. It's unlikely that the majority of us are going to be considering that. A trade sale is much more likely, and there are some different types of trade sale there. So you'll have probably seen acronyms like MBO, MBI, BIMBO even. So they simply, if you don't know, they stand for management buyout, where your management team buys you out. There's a management buy-in, where an external team buys into your business. So that's not people within your own business. There's a combination, that's the BIMBO one, where you've got some people from internal and some people from external, because obviously a team is parachuted from external buying a business. There's quite a risk if they don't really know your business very well, so it's quite often good to have a hybrid. And the one that probably most of us normally think about anyway is an acquisition by another company. So those are all examples of trade sale. There are also things, because there's an asset sale, which might happen if the business really is either voluntarily or compulsory has gone into liquidation, so that it's no longer trading. That really is only normally applicable when a business is not able to continue to trade. So it's somebody might come in and say, well, yes, there's equipment, there's assets that we can sell that would be worth more than what we would have to pay to buy that business. But typically that's not what most of us would be aiming for. And the last one, simply walk away. And in fact, if we're looking at the reasons why you might want to plan, the majority of people that don't plan a proper exit strategy simply end up walking away from their business. So they've had a living perhaps from their business as they've been building it, but they walk away basically with nothing. So what we're going to concentrate on for most of the rest of this is the trade sale side of things. So if we're looking at trade sale, who will buy your business? And typically it's going to come from people, from existing relationships that you and or your business has. So it is likely that any potential suitor is going to come from one of these 6 different areas. So, but particularly competitors. It might be a competitor that wants to buy you out. That's the one that we probably think of more often than not. Suppliers, though, also may want to buy your business to maybe integrate across the value chain and actually potentially make more profits from what they're doing. Some of your customers, occasionally, in fact, more than occasionally, it may be a key customer that is interested in buying your business. But also, as we've mentioned, employees, other groups, things like private equity firms and business angels may well be potential suitors. But a good activity that you can do that sort of kicks off your exit strategy planning is to think of the 3 groups of competitors, suppliers and customers, and make some lists. Simply list down your key competitors, key customers, key suppliers, list them down, and just start to jot down a couple of things as to why you think they might potentially be interested. So that's a good starting point. Next question in terms of how much might somebody buy your business for? Well, again, we talked about death before, and many of you will be very familiar with the phrase, there's only 2 certainties in life, death and taxes. Well, there's a third, and that third is that whatever valuation somebody puts on your business, whether it's you or somebody else, it will be wrong. There is no right answer for what the value of your business is. There are guides and there are ways to get to acceptable ranges, but you will have a different value from a potential purchaser, and there will not be a right answer. The price at the end of the day just like when you buy a house or anything else, it's what somebody's prepared to pay for it on the open market. So if you just have one person interested in buying a business, you're not going to get the same competitive pricing as if you had 2 or 3 people looking to buy your business. And it's not all about the financial performance, as we'll look at in a minute. So a valuation, when it comes down to it, is an opinion, nothing more. However it's dressed up in a complex calculation to how that value is got to, it is still an opinion. So your opinion when you value it is equally valid as somebody else's opinion. But as I said, sometimes people get more or pay more than the financial valuation would suggest that business is worth, and that's normally down to one or two things. It's either due to synergies, I don't like that word, but basically things that people can get more out of your business by having it than if they didn't have it, by combining it with theirs, or that they can immediately revalue at a higher multiple. I'll just explain those a little bit. So in terms of the synergies, really it comes down to whether they can sell more product service as a result of having your business, whether you've got a network of contacts that they can sell their stuff through. That's obviously a fantastic one. So whether they can sell more, whether they can potentially charge more because your reputation is that much higher, and actually therefore they can bump up the prices of their own product potentially, or maybe by buying you because they've got the reputation but you've got a really good network of repeating sales, maybe they can add price, charge more for the stuff that you're doing, so they can get instant value that way. And quite often, certainly when you hear about corporate mergers, a lot of it's about spending less, about stripping out layers of costs. If they've got 2 layers of central admin costs and they can take that sort of type costs out, then that's one. But there's another one in there which is worth thinking about, which is sometimes in terms of if a company is trying to break into a new market area or into a new client group and you're already in there, they've got a choice of either buying you and having instant access to it, or to set up and enter that market themselves, which of course takes time and costs. So in terms of spending less that way, it might be cheaper for them to buy you than it would be for them to start from scratch. The immediately revaluing at a higher multiple, small businesses typically will sell for 3 to 5 times the earnings and net profits. A listed quoted company will sell on average, the long-term average is about 15 times, because it's deemed to be lower risk to buy a listed company, which of course will be larger generally and been around for a bit longer. So if a business that is listed wants to buy a business that isn't listed, they will buy it for 3 to 5 times a multiple. As soon as it's on their books, it's worth 3 times that because it's worth 15 times multiple. So sometimes, if you're lucky, you get a big corporate looking at buying you, and there's a bit more flex perhaps in what they will pay for your business. So the next activity that you can think about doing is to look at those opportunities we talked about before, the customers and the suppliers and the competitors. Look at it from an outsider's perspective and think about what opportunities they might have to sell more, charge more, or spend less. And there's some examples here. Okay, so there we go. I think we talked about most of those already. I mentioned valuation, so let's just have a very quick look at valuation. And it's not the purpose of this webinar to go into complex methodologies of how to value companies, but just broadly speaking, there are 4 key methods. One we sort of spoke about before, but to do with the asset, so the net asset value. So it's not normally used for a thriving business, but if you've got stock, equipment, whatever else that has an asset value, then fine. That's one way of doing it, but that would not continue the business trading. Comparables is a common one, and that's great when you've got comparables. But if you're running a business that is not particularly, it's not a particularly common business, maybe you're unique in many ways, there won't always be comparables. If you're buying a car off of Auto Trader and you're buying a Ford Fiesta, you're going to have loads of comparables, and it's easy to do that. Equally, if you're buying a company that's listed on the stock exchange, then you've got quoted P ratios, so you get an idea of what it's worth. But if you've got a small business, you don't have those things. So typically, when we're looking at valuing small businesses, the 2 next approaches, multiples and net present value, are the common ones that are done. The multiples is dead easy. I've said before, typically a private company will sell for between 3 and 5 or 4 to 5 times the net profits at the end of the day. So it's relatively easy to get a quick ballpark valuation figure. If what is a much more robust methodology, because that takes no account of the future, you might have that's just a snapshot of one year's profits. They might take an average of the last three or four and multiply by 4 or 5 to get the value. But again, it doesn't take into any account of the future. And it might be that you've literally just broken into a new market and you know that your forecast sales are going to be much higher and your forecast profits are going to be much higher than they have been. The net present value takes into account that side of things, and you basically forecast what your profits, your cash flows will be over time, and then you discount those back to the present day to allow for the time value of money and also the risk element of it not happening. So I know that sounds really complicated, but if you just imagine yourself, somebody saying to you, I'll give you £100, your choice is I'll give you £100 today or I'll give you £100 in a year's time, you take the £100 now for certain. If they said I'll give you £150 in a year's time, you might be tempted to say, oh, actually, okay, I'll wait, because 50 quid's a pretty good return on my money to wait. There might be a bit of risk that he never pays, but equally I'll do that. And that's essentially what net present value is. A couple of other ways of thinking about potential values. Cost of entry we already mentioned. So if we know that it's going to cost somebody a year's worth of 3 people to develop something and whatever marketing cost to do it, that's what it might cost them to enter that market. And there are also sector rules of thumb. So where we look at multiples again, some sectors have particular multiples that they would do that aren't always based on the profits. And in the case of some groups like accountancies, quite often that's done on the gross recurring fees at a level of about 1 times gross recurring fees. It varies a little bit depending on the type of clients that business has. So how can we actually influence that value that is going to be given? And I've said already, it's not just on the financial calculations, which I've mentioned there, on 3 or 4 multiples or on net present value. There are other factors that come into play. Now, I ran a webinar, and there's an associated blog with the link here that I recommend you listen to. I'm not going to go into all of the ways of building a business for value, but there are some very strong principles that you can adopt. They're not overnight successes. You need to look at this probably at least a couple of years in advance of when you're going to sell your business. But there are definite ways to increase the amount that somebody is likely to be able to pay for your business. And in that other webinar and that other blog, I go into the details of these 8 key drivers, but you can see there that only one of them basically is around the financial performance and the financial numbers. The rest are essentially around either mitigating the risk, so showing that you've got the stability there, the robustness of your business, and also around the growth and the believability of that growth forecast, so that somebody can believe the fact that if you've shown them that you're going to double your sales over the next 5 years, that actually there's historical reference to prove that, and there's also a good rationale as to why you might actually achieve those forecasts. Otherwise, they're just going to discount those forecasts and not give you any upside in the value for that. And some of these are also about the level of reliance on key individuals and key businesses as well. So we're trying to remove that reliance so that again, the business is more stable, it's less at risk from one person leaving or one big customer leaving. What you can also do, so those key drivers are based on research analysis of over 15,000 businesses and the sales of those businesses. If you want to know more about that, or if you want to actually get a rating for your own business based on those 8 key drivers, then send me an email and I'll send you a link so that you can actually get your own rating. So what the next thing that with all of that in mind that you might want to think about doing is just think about what are your objectives for exit. So what is your aspiration for your sale price? You know, what if you were to write a price in an envelope and stick it away, and linked with the next one there, the timescale, let's just say it's 10 years' time, you're looking to sell your business, what number would you walk away from your business for in 10 years, or maybe 5 years, if that's what you're looking to be? And if that number is a very large number, then you're going to need to work quite hard at thinking about how you're going to be able to justify that and how you're going to be able to build your business in the meantime to get to the point where actually somebody might think about paying that number. Have a think about the target market of your potential buyers, some practical ideas for maximising value, and how will you manage the exit process. So that's a couple of things we're going to just talk about in a minute here, just at a high level. But again, part of your exit strategy here is to create a little investment story. Quite easy to do. It's only a couple of minute elevator pitch type thing, but how does your business generate happy customers, in quotes? Why do they pay you? Why are they happy to pay you for what you do? Why will this continue in the future? Here's the kind of future stability kind of thing. Why are you certain that they're not just going to disappear? Why are they going to keep coming back, or why are you going to get more companies? How are you going to achieve this despite the efforts of your competition? What separates you from your competitors? What's unique about your approach? And do the financials support this in terms of turnover, profits and costs? So I've already given you an idea of how the business is valuable. You certainly on a multiple, you get a very quick and dirty idea of what your business is worth now. If you know that you want to be able to sell that in the future for 5 times that, what are you going to do to increase those profits? So the financials back it up as well. So in terms of managing your exit process, there are really, again, there are only 4 basic ways that you're going to get your equity out of the business. You're either going to sell all the shares and leave, and there's some questions there that you might think about. And selling all your shares and leave is what many of us might dream about doing at some point. Is just getting that one big sale and then walking away from the business. But equally, you could sell all your shares and continue to work in the business, and quite often that's what ends up happening. You get locked in because somebody doesn't want all that risk of you disappearing and customers or the business falling down when you go. So quite often there is a lock-in period, and again, building your business for value in the right way will help to reduce that lock-in period. Because not many of us, having set up our own business and not being an employee, would enjoy going back to being an employee in our own business and being told what to do. So have a think about that. You might want to think about ways you can shorten that lock-in period. Number 3, sell some of your shares and leave. You might not sell them all. You might keep a few. But then what about the control business? If you find you've got 10% and then the new owners want to do something different with your business from what you had in mind, how are you going to feel? How are you going to feel about that? And then the last one, you could sell some of your shares and continue to work in the business, and you've got some of the issues around number 2 and all that kind of thing there. So those are really only the 4 basic ways. So again, something that you could start thinking about doing. Think about your objectives, your aspirations, think about your current valuation, think about your opportunities for increasing the value. Think about things that might stop you increasing the value, that would get in the way of that, because they're really good things to identify early, so that hopefully you can start to think of ways to either get over or around those barriers. Okay, think about the sale process and the tax planning side. I'm going to just touch on a couple of those things, maybe in a minute. Less the tax planning. In fact, I think that's it really. So probably the thing to do now is to open up to some questions if anybody wants a little bit more. So I haven't gone into the actual sale process itself there. I think that's a topic for another time, or maybe for some questions if people got those questions. But what I've given you here, especially if you go back and you look at these slides or listen to this recording after the event, you will have a framework here for you to be thinking about the key areas that you need to in terms of preparing your exit strategy. So thank you very much.
Great, thank you very much, Kevin. You've got some questions coming through. Okay, the first question is from Mike, and he asks, do I need to hire professionals?
The short answer is yes. Selling a business is not a straightforward process right the way through from finding potential suitors to actually making that process go through. So I think I hinted earlier on about the fact that ideally you want to make a competitive sale, because you may well get approached at some point. Someone may come to you, if you're lucky, and say, I want to buy your business. And you may decide just to sell it to that one person, but how do you know you've got the right valuation? So a broker, one of the things a broker will do is to help you to actually create a competitive situation, so hopefully you've got more than one person interested in your business. But it's not just the broker, there's also you'll need to think about a commercial lawyer to put together the various agreements. There will be a whole due diligence process that you'll have to go through, so the broker and the lawyer will help you through those. You'll want to talk to an accountant from a tax planning point of view, and you'll want to do that nice and early. And you'll probably want to talk to a wealth planner because if you are going to come out with a significant amount of money, hopefully, then you might want to talk to someone about how best to use that money and avoid the tax. So you've got some specialist members that can help with all of those things. So we've got AB Commercial in terms of Andrew Bradley and his team on the lawyer side can really help with that. You've got Simon Cook from the financial side, the tax planning side, and from the wealth planning side, you've got Simon Baldwin. All of those can offer particular help on those. So hopefully that answers your question.
Okay, great. Next question from Simon. Great question. Will I get cash?
Will you get cash when you sell a business, Simon? Well, there's hopefully, but there are different types of money, effectively, that tend to be exchanged in business purchases. So cash, great. If you can just get pure cash out, fantastic. Sometimes that will be very rarely that will be upfront, clear of any obligations. Normally there's a deferred payment linked to that opt-out, earn-out period that I mentioned earlier on. So it'll be linked to future performance. So typically it'll be split in that you'll get a chunk now, but then let's just say a year's earn-out. They might, if you've said we're going to add another £20,000 onto our profits or something over the next year, they might link the second payout to that. And certainly another reason for deferred payments might be if the people buying you don't have all of the capital up front. And I'm thinking particularly about if your employees are buying. So if they're doing a management buyout, they may not have all the capital, so they may have to do a deferred payment. And so that's cash now and in the future. And the other one is exchange of shares. You might just simply get an exchange of shares from whatever the other company is that buys you. And you've got to think very carefully about that, because how will you get your money out? It's great if that's a publicly listed and traded company. GlaxoSmithKline or somebody buys you, you can trade those shares on the open market very easily. But if another small and medium-sized business buys you, how and when are you going to get that money out? It's typically only when they sell or when they get maybe an investor buying into their business that releases some. So think about that. That was long-winded, but hopefully that answers some of those questions.
Okay, thank you. Got another question from Paul, and he would like to know about the tax that he would need to pay.
All right. Yeah. Okay. So you have to talk to a tax professional early on, possibly, ideally before you even start this process and get that advice. Typically, you will pay capital gains tax, and if you qualify for small business owner taper relief, you're likely to end up paying about 10% tax. But you need to really check that with a professional and make sure that you qualify, and that in your particular circumstances that would be correct. And then if you're, depending on what you're doing from an inheritance point of view, you're passing that on, think about the tax that might be involved from passing it on to your children or even your staff, if that's whoever you're passing it on to.
Okay, great, thank you. Next question is from Lee, and he would like to know when a good time would be to tell my staff.
All right, so all these questions are around the actual, now we're selling our business, which is great. And it's not just about your staff, is it? There's other people that need to know. There's your suppliers at some point, they'll need to know. There's your bank manager, and there's probably other people too. You certainly shouldn't tell anyone until you've thought through the implications of doing so. And the usual advice is not until you've actually got the check. Because up until that point, you don't know that it's going to happen, and uncertainty, people don't always deal with uncertainty very well. So your staff may not handle that so well. Even your suppliers may not handle that well. And the last thing that you want is a long drawn-out due diligence process, which may happen. Bear in mind, a sale will probably, even for a small business, may well take 4 or 5 months to go through. You don't want your eye or any of your staff's eye taken off the ball in that period any more than is absolutely necessary. So the general rule is keep it quiet.
Okay, thank you very much. Jill asks, what is the role of a commercial lawyer?
Okay, so as I mentioned before, it's really to ensure there's no nasty surprises and protect you. They'll need to prepare the legal documents, so there'll be the confidentiality letters and stuff, the share sale, all that sort of stuff, but they'll advise you on any of the implications going through. They'll liaise with the purchasers' lawyers, and they'll negotiate all the final draft of the documents, and they'll attend the completion meeting and make sure that all of the legalities of that transaction are done properly, and most important, they'll collect money at the end of it. But you need to have, I hope the message through some of these questions actually is that you do need to employ some professionals, even if you think they're expensive. The cost of what's that expression about? You think hiring a professional is expensive, try hiring an amateur or something. You really do need to take the right advice if you're selling a business. Thanks, Jill. Okay,
and Claire asks about professional help and what is the role of a broker?
Okay, so a broker, touched on it before, but they will manage that competitive bid process. So they will find potential acquirers. They'll prepare the original sales particulars, but they'll identify potential acquirers and they'll follow up on those. That's typically stage ones. Then they'll issue confidentiality letters to any interested parties and prepare a more detailed business profile for them. They'll conduct all the negotiations and agree indicative offers at that point. And then they'll provide assistance to you selling during the due diligence process. They'll then give detailed advice on the purchase and sale agreements in terms of, and they'll liaise with the legal advisors for that, and they'll drive that deal through, and then they'll be there at the completion meeting. So I don't know whether, maybe it's worth just a quick idea on the fees. I mentioned that these guys are going to cost you. A broker will typically charge they'll charge a commission anywhere between 2 to 5% of the sale value. A lawyer will typically charge, well, they may charge an hourly rate or they may charge at a fixed fee. And you could be into several £1,000s with a lawyer. So again, it's key to get that agreed all up front.
Okay, great. You've got a question from Gillian, and she asks, what proportion of SMEs manage to sell?
That's a really good question, and I'm going to sit on the fence with that and say it depends, and it really does depend where you're talking about. If in the States, for example, it is commonplace. Businesses sell, it seems to be the way that people do it. They're looking to set up a business and they're looking to exit that business, and it's the way they think, and it's understood that's the way. In this country, much less so, in that I don't know quite why, but there's a little bit of a stigma around thinking about selling your business, and of course there shouldn't be. So I don't have a number for you, Gillian, but what I do know is that the majority of people that don't put a proper plan together and go for it end up walking away from their business at some point, because if they haven't thought through who it might be that might buy and why they might buy, and therefore how to structure their business, it just won't happen. It just will not happen without you planning it, unless you're really lucky.
Okay, Great, thank you very much, Kevin, for hosting today's webinar. I'll send out a copy of the presentation and Kevin's contact details out to you all shortly. But before we close, just a quick reminder that this webinar is part of our service to our Smart Room members. And if you're not already a member or a BizSmart client and would like to access our archive, then please do visit our website, biz-smart.co.uk, and go to the Smart Room page. We hope you will enjoy the rest of your day and that you can join us again the same time next week. Thank you for listening.